Welcome back to Financial Freedom FX. In today's video, we're diving deep into one of the most powerful concepts in Forex trading, market structure. Understanding market structure is like learning the language of the market. It tells you where the big players are entering and exiting, how price behaves, and where high probability trades lie. If you want to master entries, exits, and avoid fake-outs, this is the foundation. Stay with me till the end for real examples, advanced analysis, and a breakdown of how smart money thinks. Let's begin with the fundamental concept, price movement. In the Forex market, price moves in waves, creating a series of swing highs and swing lows. This is how trends are formed. In an uptrend, the price makes higher highs, HH, and higher lows, HL. In a downtrend, you'll see lower highs, LH, and lower lows, LL. Each pullback or retracement provides an opportunity for the next move. What's critical here is understanding that price moves from one zone of liquidity to the next, following structure. This wave-like behavior is not random. It reflects institutional activity, market sentiment, and trader psychology. Now let's look at channels and trend lines. This chart shows a bearish trend where price is respecting a descending channel, lower highs and lower lows. Each time price touches the top of the channel, sellers step in. This is not coincidence, it's structure. Trend lines act as dynamic resistance or support. In a bearish trend, price continues to fail at creating higher highs, confirming seller strength. The structure inside this channel helps you plan entries at pullbacks and ride the move down. Understanding channel structure helps you avoid counter-trend mistakes and follow momentum. Here, we combine Fibonacci retracement with market structure. Notice how price drops sharply, then retraces to key Fibonacci levels like 38.2%, 50%, and 61.8%. However, not every retracement is a trade signal. You must align fib levels with structural points like previous highs and lows. For example, if price retraces to the 61.8% level and forms a lower high below previous structure, it confirms a continuation to the downside. Using Fibonacci without structure is blind guessing. Structure adds context, while Fibonacci adds precision. This chart is a masterclass in advanced structure. You can clearly see phases: accumulation, breakout, uptrend, distribution, and reversal. Price doesn't just trend, it evolves. Smart money accumulates orders before a breakout, then distributes them at higher prices. Recognizing these transitions helps you avoid getting caught in the middle. For example, buying in a distribution zone is a rookie mistake. Each box in the chart shows a different structure phase. By reading these zones, you anticipate where price will move next. Support and resistance form the backbone of market structure. In this diagram, price respects horizontal zones. Support is where buying interest is strong. Resistance is where sellers dominate. Eventually, one side breaks. When support breaks and price retests it as resistance, that's a classic flip zone. These are high probability trading areas. Always look left. Previous structure gives clues for future reactions. Mark your key levels and wait for price to show its hand. Structure isn't just trend lines and swings. It's also the psychology of buyers and sellers reacting to price levels. Here, we simplify structure into swing logic. In bullish markets, we see strong highs and weak lows, meaning buyers are in control. In bearish markets, we see weak highs and strong lows. Sellers dominate. Each swing high and low tells a story. Who's in control? Where is liquidity? Where is price likely to go? Mark each HH, HL, LH, LL as price develops. This allows you to forecast market behavior based on structure strength. If price fails to create a higher high, it's often a warning of a potential reversal. This is how swing structure helps protect your trades. This strategy focuses on maximizing reward while minimizing risk. Using structure zones, we define our entries near swing lows and place stops just beyond them. Targets are set near previous highs. For example, if price is in an uptrend, we wait for a pullback to support. We buy near the structure low, stop loss below, and target a higher high. This way, even if you lose, it's small, but when you win, it's big. Structure allows for tight stop losses and optimal profit targets. It's how professional traders build consistent results. This is the flow of structure. Equal highs, higher highs, break of structure, then lower highs. Each swing gives us clues about future direction. When price breaks a higher low in an uptrend and forms a lower high, the trend has likely changed. Understanding this transition from bullish to bearish is where real money is made. A trend doesn't reverse randomly, it leaves footprints. This chart shows how to read those footprints in real time. Once you see a break of structure, your entire trading bias should shift. Every market has 3 states: trending up, trending down, or ranging. In a bull market, you'll see HH and HL. In a bear market, LL and LH. In a range, price creates equal highs and equal lows. Many traders get trapped trading trends inside ranges. Avoid that mistake by identifying sideways movement early. Ranging markets are filled with false breakouts. Wait for a clear structure shift before trading. Know the market phase before you trade. Structure is your radar. This wave structure is based on Elliott Wave theory. An impulse phase has strong momentum and moves with the trend, often forming higher highs. A corrective phase pulls back but doesn't break structure. Wave 1 to 5 shows strength. Waves A, B, and C show correction. Use structure to spot where you are in the cycle. Many traders confuse wave 4 with trend reversals. Don't fall for it. If structure holds, it's just a pullback. Understanding impulse and correction helps you plan longer-term positions and avoid emotional exits. Now let's break down your real chart. We can mark each swing high and low. Price starts with higher highs and higher lows, clearly bullish. But then it forms a lower high and breaks the last higher low. That's the break of structure, a reversal signal. This is your cue to exit buys and look for sell opportunities. Real charts don't move in perfect textbook patterns, but the structure always reveals the bias if you pay attention. To trade market structure like a pro, start by identifying the trend. Mark all swing highs and lows. Wait for confirmation of break of structure. Combine with confluence tools like Fibonacci, supply-demand, or volume. Market structure is not just theory, it's a real-time tool that gives you an edge. If you found this video valuable, please like, comment with your favorite tip, and subscribe to Financial Freedom FX for more. Let's master structure and trade smart together.